Bank reconciliation. A company's best asset to highlight their internal control is cash. As companies keep most of their cash in a bank, cash controls are essential in order to safeguard their cash. There are two types of cash controls that are used by companies to control, protect, and monitor their cash that is in bank. This screencast is going to focus on bank reconciliation. Both the company and the bank record all cash transactions and can therefore verify their cash balances with each other. This is what is known as bank reconciliation. A bank reconciliation involves identifying and recording any variances in cash balances between the bank's record and the company's record. Bank reconciliation involves 3 steps: reconcile the bank balance to the actual cash balance, reconcile the company's book balance to the actual cash balance, and adjust the company's book balance to the actual cash balance. Reconciling the bank balance. The first step is to correct the bank balance reported to the company's actual cash balance. The main reasons that the bank balance will differ from the actual cash balance is due to outstanding checks, deposits in transit, and errors made by banks. Deposits in transit are deposits that have been made by the company but have not yet cleared the bank as of the statement date. In this case, deposits in transit should be added to the bank's cash balance as the cash is technically in the bank. Outstanding checks are checks that have been distributed by the company but have not yet cleared the bank as of the statement date and are therefore not accounted for in the cash balance. Outstanding checks should be subtracted. Bank errors are rare but do happen and must be reconciled. Suppose a bank records a deposit of $28,000 as $29,000. The bank is therefore recorded an extra $1,000. Adjustments should therefore be identified, corrected, and reported on the statement of financial position. Reconciling the company book. There are also 2 main reasons the company book may differ from the actual cash balance, these being bank activities and errors. Bank activities may affect a company's cash balance, but may not have been recorded by the company. Such bank activities can be an addition or subtraction to the company's cash balance. This can happen when the bank collects or distributes cash on behalf of the bank. An example of the bank collecting money on the company's behalf is interest and company receivables. An example of the bank distributing money on the company's behalf is returned customer checks from insufficient funds or banking services. All of these examples need to be either added or subtracted to the company's book balance. Errors made in company records also need to be recognized and adjusted. Such examples are similar to those of errors made by banks. Adjusting the cash balance. Once the company's and bank's balance are equal, the company's cash balance must then be adjusted to the correct cash balance determined by the reconciliations. After this takes place, the company's book balance must be correctly adjusted to the actual cash balance.